Hello and welcome to the December RCA webinar and discussion where we're going to talk about one of my favorite topics, what is truth in costing? My name is Larry White. I'm the director of the RCA Institute. Today we'll be discussing truth. Now this isn't about truth and lies, but rather what constitutes a fundamental truth or principle. As many of you know, costing can be somewhat surreal as it is applied by accountants in many situations. And we'll discuss why that is. Right now, all of you are on mute. After the discussion, I will open the, or I guess I'll invite you to unmute. You can choose to do that or not. And if you have any questions, comments, or discussion topics about today's presentation, I'll happily invite those. I am recording the presentation. I will turn off the recording when we begin the discussion or as I finish the presentation. So first, let's talk about some types of costing. The most typical type of costing is costing that's done for financial statements in accordance with generally accepted accounting principles. Now, what's important to remember about this type of costing is that it is designed for an external audience, not an internal audience. It's designed for the purposes of comparing companies to make investment and credit decisions, and that financial statements are clearly identified in the conceptual framework for financial accounting standards as general purpose financial standards. And the overall key to costing for financial statements is compliance with standards. The kind of costing that I'm primarily discussing today is costing for internal management decisions. And they must reflect cause and effect relationships very directly within the organization and, in some cases, connections outside the organization. Now, the big issue in internal management decisions and costing for internal management decisions is compliance with what? And this is a big issue. It's a source of confusion in organizations and a source of confusion for many accountants. So a little more on financial accounting before I go with that. Of course, what we have is financial statement presentation, and that's a critical element in many parts of the accountant's world. The question, though, that I want to bring up is generally accepted accounting principles the truth? It is a consensus-based standards, at least in the United States. A group of 5 people and their staff up in, Fairfield, Connecticut, go through a process that involves a lot of input and an agreement among them and many stakeholders to come up with financial statement presentation standards. So, and of course, there's the audit. Again, does that make it true? Well, you must be truthful in the presentation because in most cases, if you're a public company and many private companies, you're audited. But does the presentation in the financial statement represent the truth? Well, this slide that's been hanging around, this set of pictures down at the bottom, is I like to think about accounting this way. Is it a law of nature, purely a reflection of reality? Or is it a law of man? And laws of men are, in fact, social consensus. So we've covered financial statements. So then let's challenge ourselves to say, what truth does managerial costing seek to represent if it's not the same as in financial statements? My answer to that is managerial costing seeks to represent the resources and operations that exist in the organization and that you intend to model. It needs to be a monetary reflection. I sometimes find the word financial a little bit confusing because it drives people towards financial statements. A monetary reflection of those operations and the resources they engage. You know, when you think kind of deeply about this from an inside the organization perspective, resources and processes are what managers really make decisions about to create value. It's not, for most managers and decision makers, it's not about the money first. It's about using the resources efficiently and improving the processes. And shouldn't these decisions be made from something that reflects the reality of them, like actual cause and effect relationships? Now, if you've done costing a lot, even if you've been a CFO, I'm sure at some point in time, you've been asked for a true cost or a relevant cost. And when you're asked for that, it's really a veiled question for something other than what is on the financial reports you have provided. So what about relevant cost? What is it? It's actually a word I dislike very much. Whoops, what did I do? Folks, I'm sorry. Oh, there it is. Okay, so relevant cost normally means relevant to the question at hand. So someone's asking you or challenging you on a particular cost number you've provided, and they are saying it's irrelevant. It's a deviation from the costs that are calculated generally in line with financial statement presentation information, or the information in your accounting system that leads to financial statement presentation. And then what ends up happening is you kind of start with a number based on a GAAP convention, and then you monkey around with its inputs and its elements and struggle to make it relevant to the question or decision at hand. Resources don't change unless you take action. So monkeying around with costs really doesn't do much for you except for win an argument. But financial statement costs can change due to many irrelevant factors. Production and volume changes, increases or decreases in inventory, depreciation conventions, allocation factors. All of those are not substantive things from an operational point of view, but they certainly can change your cost numbers. What about, whoops, did I miss something? I'm sorry. What about true cost? Well, true cost is another interesting set of words. I still am fighting against people using this. Again, it almost always means something other than what the financial accounting system is reporting. I used to have a motto when I first got into management accounting. I said, I'll make it cost whatever you want, just give me choice of adjectives. And that was a very creative thing on my part, but nowadays I actually think of it as downright unethical, because I thought I was just monkeying around with financial numbers to win a particular decision outcome. I wasn't really changing anything except the perception of operations. So we're back to this question. What is truth? And how can it be defined for managerial costing for internal decision support? Well, when you look in Wikipedia and do an inquiry on truth, what you find out is that there are 5 major theories of truth, and I've listed them here. The first one, the correspondence theory, is the area we're going to focus on, because what it says is truth corresponds to facts, and it's the only theory of truth that is purely reality and science based. You see below it 4 other major theories of truth, and they all have an element of human and social agreement or coherence that that might change what truth actually is, away from purely facts and reality. So I'm going to say, in the broadest sense, that the correspondence theory of truth is what managerial costing needs to follow. I'm pretty sure if you study it, you'll find elements of those other 4 theories do apply to financial reporting standards, because there's a great many compromises there. So what is the correspondence theory of truth? Well, this mouthful, and I'm not even going to try to read it because I always get tongue-tied, is how Aristotle, who named it and defined it, described it. The simpler way is a statement or opinion is true if what it corresponds to is a fact. And for managerial costing, the facts are the resources and the processes you're seeking to model and manage. It's that simple. There are some interesting quotes over time from the accounting profession. I'll read the first one, read them both. It is very important that the cost should not be regarded as something that may be manipulated, nor should they be thought of as representing anything but the cold truth, however unwelcome that may be. That was from 1910. And more recently, though not very recently anymore, over half a century ago, the cost accountant was concerned not merely in the presentation of facts, but his objective was, insofar as possible, a presentation of the truth of the facts. That was from, I think he was a professor. The AAA committee apparently spent a lot of time trying to write cost accounting concepts and standards, and as I understand it, they failed. But it's a good quote. So there are some truth issues with managerial costing, this trouble with truth. Now, one of the reasons I bring this up is because a lot of times you hear presentations, particularly from audit firms, talking about one version of the truth. And of course, they mean the financial statements and the financial accounting system. I challenge them on that every chance I get and reject that notion. So some of the issues for managerial cost are, if there were no standard or fundamental truth, on what basis can new theories be challenged? I mean, we all know believers in management accounting approaches. They're strong believers. And we've all been in endless arguments. And part of the reason for that is because we haven't agreed on or defined a fundamental truth. You know, if there's no truth, then there's no lie, no error. And real progress is stifled. Critical thinking, a key ingredient to progress, is diminished if you don't have a basis of truth. How can we prove that any one approach is better than any other approach? There's no way to do it. without an agreement on what constitutes truth for managerial costing. The impact of this lack of truth, this kind of Wild West situation that's existed in management accounting and managerial costing, is the lack of a recognized common frame of reference makes it difficult for the profession to effectively communicate. We have people that use the letters ABC for what they believe costing is. Now, there's a million versions of ABC too. I mean, depending on the quality of the model you build. So the other impact is that management accountants are not able to make a convincing case and demonstrate, in many cases, how improved costing adds value to the enterprise. That is beyond the limited application established in the standards for financial reporting. Everybody will invest in a new financial system if it makes financial reporting difficult. It's a much harder case to win to put in place a distinct managerial costing system to improve the quality of information. Now, the good news is that the Institute of Management Accountants has worked very hard and has created some statements of management accounting. And I'm very happy to say I was part of all these. So we created the conceptual framework for managerial costing that defines two core principles and a series of concepts associated with managerial costing. And that's costing to support internal decision support. Then we wrote a couple of other SMAs, developing effective managerial costing model, costing system attributes that support good decision making. That's totally focused on causality. And now we did the profitability analytics framework, which it kind of extends the causality principle out to revenue and into investments. There was also a task force report on the conceptual framework for managerial costing. It's quite lengthy, but it goes into a lot more detail about the issues. And frankly, I don't think the IMA is posting that anymore. So if perhaps you want a copy of that, you can contact me, and I have it electronically, and I can send it to you. Where does RCA fit into all this? Well, RCA is the only managerial costing approach in the marketplace today that is completely principle-centric, not method-centric. RCA does not bet the house on a specific method. For example, the use of activities. We use the techniques of activity-based costing in RCA when they're appropriate and useful and efficient. But what we focus on primarily is a reflection of resources and processes. It applies the principles and concepts for managerial costing from that statement of managerial costing consistently and appropriate to the kinds of decisions an organization makes. Not every principle and not every concept needs to be done in depth by every company based on a variety of factors. And as I just stated, it's very compliant with the IMA's conceptual framework for managerial costing. I always put this slide at the beginning. This time I put it in the end, just showing what RCA is. RCA is a mix of German management accounting methods known as Grenzplan Kostenrechnen, or GPK, and activity-based costing. The focus is on internal decision-making, not external reporting, linking operational metrics to finance and vice versa, and reflecting clear cause and effect relationships among resources and processes. So I'm going to finish with that. I hope I've given you some insight and some thoughts into truth in managerial costing and the importance of establishing a baseline of truth to spreading the word about the need for improved internal decision support costing. Everybody has their external financial reporting. Many don't understand just how important and how different internal decision support costing can be to their organization. I'm going to stop